Hello and welcome. You're watching First Take here on News 9, where we bring to you the morning buzz on the last street. I'm Suyash Maheshwari, and with me in the studio is Amit Ranjan. And it's a Thursday morning, and the markets, they have kicked off the session at record high. Nifty, Sensex, the mid-cap index, all have in fact opened at record high levels. And I mean, looking at the sectors, most of them are trading in the green as well. It's the pharma pack that's showing some bit of weakness this morning, but overall a very strong opening and a rather surprising one at that. So one may wonder, what's driving the markets. First is the HDFC Bank. I mean, the bank alone was responsible for about 70-75% of the gains in both Nifty and Bank Nifty this morning. This was, by the way, on the back of the Q4 business update that came in this morning, this morning as well, which showed very healthy deposit growth. Overall, the numbers are looking rather superb. So HDFC Bank is one factor that's driving the markets. And second, today, remember, is a weekly F&O expiry for Nifty contracts. So perhaps some bit of a short covering is playing out. But, we'll decode all the reasons why the market are exuberant this morning. Let's first take the temperature of the global markets, because green patches have started appearing over there as well, Amit, isn't it?
Green patches after a sea of red yesterday, but I am tempted to believe that there is a strategy of the Fed to keep the world on tenterhooks on when the Fed rates are going to happen. Now, data from the Institute of Supply Management in the US suggested that manufacturing in the US grew for the first time in a year and a half. While that would suggest a strong economy, it would even also tempt the Fed to hold back on their rate cut, this being an election year. The Fed chair, Jerome Powell, has reiterated that there will be a rate cut at some point in this year. So again, my theory of basically just playing with the global markets and a strong dollar at that has sent basically shivers from Tokyo to Istanbul, and governments are stepping in to keep their currency strong with words and deeds. Now that also goes towards the Fed being tempted again to keep the pass on the Fed cut for some more time. Like you said, Dow Jones closed slightly in the negative at 0.11%, but both Nasdaq and S&P were in the positive. S&P 500 in the positive at 0.11%, Nasdaq in the positive at 0.23%. Stock 600 was in the positive at closed in the positive at 0.29%. The Hong Kong and Taiwan markets are closed today, so they Hang Seng closed yesterday in the negative at minus 1.22%. Nikkei today, although, is up 1.66%.
All right, and apart from the manufacturing data that came out, which, by the way, as you rightly pointed out, showed a surprising uptick, manufacturing activity in the US did, moved into that expansionary phase after a gap of nearly 1.5 years. But last night we had the services data also that came out. And remember, services PMI and services, is a more sticky number, and that perhaps lends to inflation, but that number has declined on a month-on-month basis. It's still in expansionary phase. And again, as Amit pointed out, Mr. Powell spoke again. He said that policymakers will need time to assess the inflation situation, which, by the way, leaves the timing of a possible rate cut, uncertain. And speaking specifically about the stronger than expected price pressures at the start of the year, Mr. Powell said that he and his fellow officials are in no rush to ease monetary policy. And if you look at, pretty much the other cues that we track, the bond yields, the dollar index, they are pretty much on a flattish note. Again, oil price remains a concern. It's nearing that $90 a barrel, but currently the markets are just turning a cold shoulder to the global headwinds, Amit. I mean, look at the phenomenal rally we have been able to stage this morning. Opened at record high, certain pockets of the market, the Sensex, Nifty, mid-cap, all hit record high in the morning trade. Although we are seeing some bit of a pullback, Nifty as we speak has in fact moved below the 22,500 mark. We are seeing some bit of a price pressure over there. Sensex is still holding above 74,000. Mid-cap index, which again hit a record high today, is trading up about 0.3% higher. The small cap index remains the strongest segment of the market, and it has been the strongest segment of the market for the past 1 week or so. That is up 0.6% as well, and volatility, I mean, that continues to remain in a very, very comfortable zone below 12 levels. But to understand what's driving this market and where can we go from here, let's welcome Soni Patnaik of JM Financials. Thank you for joining us here on News 9, Soni. Always a pleasure speaking with you. And Nifty for the last couple of sessions has essentially been flat, and I mean, you could have made a case for both bulls and bears, right? But a strong gap up opening today, the index decisively broke above that congestion zone of 22,500, 530 odd levels. I mean, that should perhaps tilt the dynamics in the favor of the bulls, right? Or do you see this this as a short covering phenomenon that's taking place, considering that today is a weekly FNO expiry?
Good morning, Suyash. Thank you so much for having me on the show. See, yes, Nifty did break above the congestion, the gap up, but then we can see that it did not sustain, rather, not even just for 1 hour could it sustain above those resistance levels. Yesterday's FI's data was indicating that it could be a bit of a cautious to hedge note for today's trading session. So in either way, it was always sensing that just avoid any such gap up and do not hurry into buying those gap ups. Just hold on to your position. The market is more or less right now a buy on dips. There's a multiple crucial support, but then it's imperative to buy around the support level. So if we talk about Nifty, around 22,400, 22,300 could be that zone where one can buy and just keep a stop loss of 22,200. This can be a positional play. So buy around those support levels, and from there it should bounce towards 22,800, 23,000 can also be tested. It may not happen today. It may happen in 3 to 4 more days. There's an event tomorrow. So ahead of the event, there's just some bit of a consolidation sideways move and nothing much to panic. It's pretty much a buy on dips. The key index to watch out for this series is definitely Bank Nifty. I think Bank Nifty is the one that can lead Nifty out and pull Nifty out of those consolidation levels and head higher. So I think Bank Nifty on expected lines, there's a resistance of 47,500, 40,000. It has been breaking those resistance in 3-4 days trading session and almost loitering around those resistance level. It has reached 48,000, 48,100, where it was expected to have another round of resistance. So Bank Nifty is taking its sweet time to just break out of its resistance. Above 48,200, you can see Bank Nifty heading and retesting its previous all-time highs of 48,600. Any move above 48,600, Bank Nifty can definitely rally towards 49,500, 50,000 mark. So I think these are the key levels to watch out for. For support in Bank Nifty, 47,500, 47,200, 47,000, multiple support levels in both technical and derivatives point. I think just watch out. I think Bank Nifty could be the one. And most likely you can see those upside bullish green rallies starting from maybe tomorrow after the event is over.
Good morning, Soni. I'll like to drive your attention towards L&T Finance. Now, their retail disbursement has jumped 33% to 15,030 crores from in the Q4 FY24 from 11,282 the same quarter the previous year. The stock right now is around 171.85 rupees, and the distance from the 52-week high is just about 5%. The stock has done very well in the last 1 year, but last 1 month it has been slightly in the negative. What do you make of L&T Finance? Good time to get in while it is still low, or is it going to break the 52-week high in the immediate term?
So if we look at L&T Finance, the chart is indicating it can head towards and break those 52 weeks high, but then it's better to always enter at a dip. For this stock has been running for the last 3 days continuously. There's a resistance of around 175. Today also it has tested 175. So there could be two strategies to adopt. One could be that you buy on dips. The dip can be around 168, 165. Those levels could be quite important to just buy. Keep your stop loss at 160. So the risk reward ratio becomes favorable, and then again it bounces to 175. You can book your part profits. The second strategy is if it's able to break above 175, we can see a continued rally towards 185, 190 levels as well. So I think this could be how the strategy can be played. Just adopt a buy on dip strategy with 160 stop loss.
All right, and buy on dip seems to be the mantra for this market. I mean, look at how strong the recovery has been across the board when we talk about, the broader markets on Nifty. But one particular stock that had been, in a long stupor was Avenue Supermarts. That broke out, and we are at a 52-week high on Avenue Supermarts. It has surged by about 14% in a matter of month. This morning even it has surged about 5%, and this is on the back of a very strong Q4 business updates. Revenue has jumped by about 20% year on year. Store additions have been healthy. But coming back to the stock, Sony, phenomenal returns in the last 1 month, but again we know Avenue Supermarts has not done much in the past 12-15 months even. What's your take on the stock? Can this rally continue?
So, Suyash, if we look at DMart, then definitely, it has tested, it has broken, it's given a good breakout today above 4570 levels on charts. It's a good breakout and tested 4700. Then, of course, with the market being so choppy and volatile, it has also slipped off from its day's high, but not much to panic. You can see good volumes already added up in the first half an hour itself, and the stock definitely can soar higher towards 4800, 4050 also we can look at. I think just hold the stock, keep trailing your stop losses. The ideal stop loss to be trailed at right now comes up about to be 4570, 4550. So I think that range can be your stop loss for the current positions, and as well somebody who's already holding it from a lower level. Trail your stop losses and look for higher targets towards 48, 4850.
So a hold for Avenue Supermarts. But Sony, what are your stock picks for our investors today?
So the first, I think, one was Laurus Labs, and it has almost, it's very close to its target itself. I think the target was around 460. It has made a higher 53, sorry. I think one can just continue to hold Laurus Labs with stop loss of 425. That becomes a first. The second buy was in AU Bank. I think AU Bank has already hit the suggested targets. It was 630, 640 with the suggested targets. It has already held. Its stock looks quite strong, and even in this market, you can see that the stock is not correcting. So one can just continue for an extended target of 660 and trail your stop losses to 615 from current levels. So I think this can be the second. The third pick is in Havels. Havels is a conditional buy. The condition is to buy only above 1560, 1565 levels. So I think that's the condition. The moment you see Havels crossing those resistance of 1550, 1560, 1565, then you buy Havels with a stop loss of 1520 and a target of 1700. So I think that's very important. Just watch out and do not hurry into current levels. Wait for the resistance to cross. The fourth pick is in Kolpal. Kolpal, we've seen it, just take away highs from, morning highs. We've seen it fall down. However, 2700 is still a very strong support. So one can just buy in these current dip and revise the stop loss to 2700. Hold your positions to 2700 stop loss, and targets of 2900 can be seen in Kolpal.
All right, those are the top trading ideas from Sony Patnaik for the short term. Thank you, Sony, for giving us time here on News 9. Always great insights from you.
Likewise, thank you so much for having.
All right, with that, let's slip into a short break. On the other side, Amaro Singh of Angel One joins us.
"40 countries, 1,000 multilingual bookstalls, 1.25 lakh people, one destination, the New Delhi World Book Fair 2024.
So it's a great honour to be here. Thank you to the National Book Trust and those that have embraced us over recent days.
I was at the London Book Fair once and I had not participated here, but this fair is an ocean and it's beautiful.
This should be your annual spring picnic.
Through the power of knowledge, we are going to create responsible citizens with global skills and also global responsibility.
This and more. Streaming on News 9 Plus. News is now content. Subscribe and get free vouchers.
India's ever-evolving urban landscape is witnessing a new revolution. And this one comes on 4 wheels.
The affluence has been growing. Cars are becoming more a reflection of what you are.
Nobody's talking about hatchbacks. Now what next? The next is the SUV.
The contribution of SUVs is close to 55-60% of the automobile sales these days.
Is that even manufacturers like to sell SUVs?
So, how did a nation obsessed with fuel economy come to love heavy gas guzzling sports utility vehicles? Let's look at how India fell in love with the SUV.
This and more. Streaming on News 9 Plus. News is now content. Subscribe and get free vouchers.
Golf as a game, it is closest to the game that you call life.
You've got to use your mind. You cannot lose it.
The sharpest person is one who understands his limitations.
खुद ही को कर बुलंद इतना कि खुदा बंदे से पूछे कि तेरी रजा क्या है.
You might have a bad break after a good shot. You might have a good break after a bad shot. But the fact remains, you got to play the ball from where it lies.
Watch Jeev Milkha Singh on Duologue with Barun Das, streaming on News 9 Plus.
Why is the state not looking at putting an embargo on that?
As a Telangana person, I will not accept.
How do ordinary folks deal with this?
Welcome back. You're watching First Tick here on News 9, and the markets, I mean, they have turned quite volatile this morning. You know, we had opened at record high. All, you know, the mid cap, the Sensex and Nifty all had hit record high in the morning trade, but we have seen a sharp correction from there on. If you look at Nifty, it has turned negative for the day. It's down about 0.2% as we speak, has fallen 200 points, over 200 points from its day's high. In fact, has slipped below the 22,400 mark as we speak as well. Sensex is also back below the 74,000 mark, and mid caps has pretty much evaporated all its gains as well. It's up marginally, up 0.08%, but you know, still holding above the 49,700 mark. Small cap index has fallen from the day's high, but you know, that remains the strongest pocket of the market. It's up 0.25%, and look at the pickup in volatility. India VIX was essentially flat this morning, but you know, in the last 10-15 minutes alone, we have seen a 3.6% spike in India VIX, and it's at 11.78 levels as we speak, but still in a comfortable zone for us. But to understand, you know, what's going on in the markets, why are we seeing that, you know, this high volatility, let's welcome Amaro Singh, Senior Vice President of Research at Angel One. Thank you for joining us here on News 9, Amar, and a great time to have you, because the markets, I mean, we are all trying to make sense of what's going on. Today, this morning, I mean, it essentially opened at record high. It did, in fact, 22,600 is where we reached on Nifty, but from there on, we have seen a sharp drop of about 200-250 points. I mean, what's going on, Amar?
Yeah, that's a very interesting question, and also the way the markets opened with a gap up almost 150 points, and then the markets corrected. So that tells me that we have to be prepared for volatility, and also you have to understand one thing, and I would say our viewers need to understand one thing very clearly, that don't just get sucked in by the euphoria or by the volatility. Give the markets, whenever the markets open in the morning, at least give it first 15 minutes, let the markets settle down, because many a times the traps are set in the first 15 minutes of the day, either on the upside or the downside. So I would say even rather 15 minutes, look at a 30-minute time frame. Let the markets or the stocks consolidate and feel their level. Then you get into the markets, rather getting into on the go, expecting that the bullish momentum is there to stay. That's a very, I would say, very dangerous belief to have. Because most of the time, majority of the time, you'll find that the markets really trade the opposite way from the gap up or gap down. So having said that, if you look at the major indices, Axis Bank at a point of time was trading significantly higher. So that has corrected. Apart from that, if we look at from the highs, Axis Bank has corrected. If I look at HDFC Bank, HDFC is one which is still holding up. So that's one positive side. If I look at Infosys, again, sell-off in Infosys from the highs of the day. If I look at Reliance, again, from the highs of the day, Reliance has corrected. So most of the heavyweights, SBI also has corrected. They haven't corrected significantly, but yes, that correction is sufficient for the markets to really give up the gains. So if you look at the broader sense of the market, still that's in favor of the bulls. But yeah, it's and see, you have to understand one thing: whenever the markets are trading at record highs, you have to be prepared for extreme volatility. India VIX comparatively, that's only at 11, 12 levels, so there's nothing much to worry about. But you have to be prepared for volatility. If you can stomach such sort of volatility, then you can be in the game. Otherwise, stay aside till there is some further clarity, because markets are going to remain volatile, and also as we have more events lined up, we'll see this sort of volatility there to stay.
All right, and I want to circle back on HDFC Bank, because at one point it was alone responsible for about 70-75% gains in both Nifty and Nifty Bank, and it was not just a technical breakout that we had witnessed a couple sessions ago. The Q4 business updates came in this morning, and they were essentially like, superb set of numbers. Look at that deposit growth of 26% year on year, 7.5% quarter on quarter, and Amar, that had been a pain point for banks, right? Poor deposit growth. Your thoughts, sir?
Yeah, I would say that definitely has been and continues to be a cause of concern for the banks. But we have to understand that investors are also looking at different avenues as well. Because if you see the way the mutual fund industry has been growing and the future also holds, apart from that, you look at the AIFs, you look at the PMS. So earlier, all these funds were more or less getting into the deposits, or in some form or the other, they were getting into banks. But that trajectory has completely changed. At the same time, the credit offtake, how that happens for the corporate, because there also corporates are, I would say, if you look at the Indian corporates, they are not growing at a breakneck speed. They are growing at a slow and steady pace, where they feel that they require, because a lot of them have burned their hands stretching themselves too far, too wide and too soon. So these are some learnings which corporates of India, apart from, I would say, the large corporates, medium or small, they've all learned through the hard way. So I think that also is there, and also we'll have to see, because ultimately it's also a lot to do with the employment creation, how that happens, job creation, how that happens, how the overall economic growth trickles to the last man standing. So these are certain areas where a lot of things needs to be done. But having said that, for HDFC, I have been saying that the worst definitely seems to be over. The low that the stock had made, that is a very strong support zone. So that was around, if you look at the low, that was around 1350 odd levels. If you look at the upside, 1550, 1560, that's a zone of resistance for HDFC Bank, where you could witness some profit booking. But the stock still is in a no man's land. It's more generally a trendless stock, so it's more of a trend play in this particular stock.
All right, HDFC is a trend play at this point in time, but seems to be out of the woods for now. And Amar, since HDFC Bank has posted such strong numbers, have you revised your expectations for other banks as well? Which banks do you prefer, among this large cohort of private banks?
So if you look at a large cohort of banks, I would say Axis Bank is one which is quite positive even on the long-term charts. But again, in most of the banking stocks, post the rally in some of these stocks, because if you look at ICICI Bank also had a decent rally, but again it has gone in for consolidation. So now most of the large cap and these banks, I would say the bellwether banks or the leaders, they are showing signs of fatigue. That is clearly there on the charts. So except SBI still continues to be stronger on the charts, but again, I would say it's early days to say that it's formed a top on the intermediate term trend. But amongst all these banks, SBI is comparatively better placed compared to the private sector banks, be it I would say ICICI Bank or HDFC Bank, or I would say for that matter Axis Bank, or for that matter even Kotak Mahindra Bank. So most of these large banks are witnessing, means investors are not really ready to play a long-term bet on these banks at the current level. That clearly is visible on the charts also, and that we'll have to see. Now the data which the business data that has come out from HDFC Bank, we'll have to see how this, because it has to set a pattern, because it has to set a momentum. It can't be a one day surprise. It has to be whether it's a regular thing or whether it's just a one-off case. So we'll have to watch out for that as well.
All right, and Amar, another space that we are tracking is the IT services, I mean information technology services stocks. And yesterday when the market was falling, it was the IT stocks that provided some bit of support. And Amit over here, what was the big news? What happened as far as the IT stocks were concerned?
IT stocks in the last 1 year, Suyash, have not really performed. Even the Nifty IT, around 27% gain over the last 1 year. Now the US-based global brokerage firm CLSA upgraded its counters for the IT pack in India, and specifically they said the standout performance is going to come from TCS, which is going to be the top performer amongst the pack. And the target call for TCS, CLSA raised it to 4,043 up from the earlier 3,925. But the upgrade was to an underperform from a sell call. The next that the target that they raised was of HCL Tech, which was raised to 1,553 up from 1,536 earlier, again to an underperform from a sell call. The third one, which they had already given a big outperform call earlier on, was Tech Mahindra, and they reduced that call to a buy call, and the target was reduced to 1,508 from 1,518. Now that is basically it. Amar, my question is it because this pack has not really performed, and even in the last 5 days if we look, most of them are floundering in the either slightly in the negative or just above zero as far as gains are concerned? Is it because of that CLSA feels that it is time that this pack is going to basically have conservative gains in the times to come?
Yeah, I would say if you look at the overall macro of the IT stocks, I would say primarily the major ones, we are seeing that there is definitely concerns with regard to going forward in terms of the revenue growth, in terms of the bottom line growth, top line growth, and also in terms of the orders. Because having said that, US though is seeing some good decent growth, but there's a lot of structural changes that's happening, and also in terms of the order flows, that is a concern there. And also what we are seeing is that the way technology has been evolving and the way going forward, how these companies are able to really cope up with the future, next 3 to 5 years, that's going to be very interesting to watch out, because there we could see a lot of surprises happening. Because a lot of work which is being done by many of these companies that might be redundant or might become redundant going forward to a certain extent. So how these companies really cope up with that also markets or investors from a long-term perspective, they are factoring in. Having said that, if you look at some of the major stocks which you mentioned, like TCS. Now, TCS on the long-term charts, though it looks good, but intermediate term trend, we are seeing consolidation. Short term, we've seen the stock correct towards 3,800, 3,850 levels. Currently, it's around 3,950. So it's more of a range play in TCS. If I look at Infosys for that matter, Infosys is comparatively weaker than TCS on the charts. So that clearly is visible on the charts. If I look at some of the other stocks which you mentioned, like for example, Tech Mahindra. So what exactly is Tech Mahindra doing on the charts? Again, it's not very strong on the charts. So what these major stocks, IT stocks, are displaying on the charts is that investors are not really gung-ho about these particular stocks or this sector as of now. There would be some stocks maybe where there could be some interest depending upon how they really plan out their future and what are they exactly doing in their current scheme of things. And having said that, if I look at the Nifty IT, because ultimately that really tells us the broader picture. So there again, we are seeing consolidation. After the rally, again, it's around 35,000 odd levels, Nifty IT. It's more or less consolidation. So I would say that IT, you have to be very selective. We want to get into IT, don't expect some major returns, at least in the short term, unless we see some very positive developments coming from the US.
Do you see the IT companies going through a sort of a tectonic shift as far as their structures are concerned with the coming of AI and quantum and those sorts of technology and large language models, where India has been a laggard? So do you see a period where there will be a low phase in these companies where they are basically restructuring themselves to brace themselves for the new realities.
And that's a very interesting point that Amit made over there, because, you know, look at what happened in the US markets. It was the rally to record highs was primarily driven by this, you know, 4 or 5 tech stocks. So it makes sense for them to also shift focus to, what's the trend, which is AI.
And an interim period when this shift is happening.
Yeah, so if we look at the IT stocks and companies going forward, there's no doubt about it that the technology shift that we are going to see in the next 5 to 10 years, 10 years I would say is a longer period, 3 to 5 years is going to be something which is going to be extraordinary and phenomenal. So there is no doubt about that. And there how these IT companies are actually able to cope up with and really come up with so that they can manage their revenue streams as well. Because what's going to happen is that a lot of the work, which I said, which the companies, many of the companies are outsourcing to these IT companies, that they might start to a certain extent doing on their own. Because a lot of the activity would get automated, a lot of it would be very easy even for non-programmers to really take up that. So these are areas which is going to explode going forward in the next 3 to 5 years. So I would say, so there definitely is a challenge, but at the same time, every challenge comes with an opportunity. So we'll have to watch out how these IT companies really are able to live up to the challenge. And as you rightly said, we are behind the curve in terms of the latest technologies, no matter what we say. So there's a lot of catching up for us to do. So it's going to be interesting times for the IT sector as well as the overall industry at large.
Interesting times for the IT sector for sure, sir. But we are in a new financial year, and I have to ask you, what are the themes and the sectors that you are betting on in FY25?
So if you ask me, the sectors which are definitely going to be of interest is one is the tourism sector. That's an area which is going to be of great interest. So it could be the hospitality sector, it could be the airlines. So because the way we are seeing in terms of the Indian traveler, that number is going to grow multifold over the next 3 to 5 years. So those who are catering to these this segment is going to be see a lot of opportunity there. So that's one sector one can look at. The second sector which I see is the NBFC space. So there it would be a challenge for some of them, but how they are able to manage their NPAs. So that again is an area. Now it is real estate is a sector which is expected to do extremely well. But that would be more dependent on, I would say, interest rate cycle and overall economy at large. But we are seeing a lot of growth happening across all tier cities, and also the way the luxury segment has taken off, and that appears to be there to stay unless we see some major tectonic shifts happening in the global economy at large, which could have an impact on our economy. So these are a few sectors. And lastly, defense. Defense and defense sector is one sector which, again, I would say, just like we've got some defensive sectors called FMCG, pharma, wherein even in bad times you generally tend to find some solace in these sectors. Defense is also an area where we are seeing significant growth and opportunity there. But again, one needs to remember that not every price is a price to buy, not every price is a price to sell. You should ideally wait for some correction, meaningful correction, and get into the stocks. And also, if you're looking at from a long-term perspective, look at it like you buy 20-25%, and then again you buy 20-25%. And so you build a portfolio of stocks in a SIP form, and then you hold it at least for a 3 to 5 years, because just holding for a 1 year period is never a good idea, because that means you are timing the market from an investing perspective, which is never a good idea. But if you average it out, then you'll find you are far better placed, and the probability of being on the right side increases significantly. So that's something one definitely needs to do.
All right, and so interesting that you picked the winners of the past to be the winners of the future as well. But on that note, thank you for joining us, and great insights from you as always.
Thank you for having me on the show.
But before we wrap things up, let's look at how the markets are doing, because Nifty again is very close to its intraday low. We have once again broken below the 22,400 mark. In fact, we are just about 10-15 points away from the intraday low today. Nifty is down 0.2%. Sensex is also trading below 73,800 levels. The mid-cap index, remember, it touched a new record high. It had scaled 50,000 for the very first time in today's trade, has also slipped below those levels about 190 points, but still trading in the green with a gain of about 0.15%. The small cap index is up 0.3% at 16,200 levels, and volatility is rising. India VIX as we speak is quoting at 11.7 up 2.9%. But on that note, let's end the show. We'll see you at 4 p.m. to make more sense of what happened in the market. But up next is World Business Report.
India's ever-evolving urban landscape is witnessing a new revolution. And this one comes on 4 wheels.
The affluence has been growing. Cars are becoming more a reflection of what you are.
Nobody's talking about hatchbacks. Now what next? The next is the SUV.
The contribution of SUVs is close to 55-60% of the automobile sales these days.
Is that even manufacturers like to sell SUVs?
So, how did a nation obsessed with fuel economy come to love heavy gas guzzling sports utility vehicles? Let's look at how India fell in love with the SUV.
India produces between 1,500 and 2,000 films every year, the highest for any country. But they get